Okay, looks like we have stopped having attendees join. So welcome everybody. We hope this day finds you inside and warm and safe and healthy. I just want to remind you that we will be recording this meeting and it will be up on our website in the next couple of days if you would like to listen to it again. You can also add questions in the Q&A section, which should be at the bottom of your page. Please put them in as we go along, and we will attempt to answer the questions that you ask. So again, thank you for joining us for an update on the state of the market during the election season. And we are truly in the last sprint of the election season, with only 6 days to go. I'd like to introduce our panelists. Joining us, at least in the center of my screen, is Dave Lynch, our Chief Investment Officer, Ryan Hanna, Director of Equities, Eric Gisome, Director of Fixed Income, and David Strawn, who's the Head of Relationship Management. So our format today will be for each of the panelists to make a few opening remarks about their particular sector of the market. And then I will ask some questions and also, again, welcome you to put questions into the Q&A feature, and we will work on answering those. So Dave, as we start, be great if you could give us an update on the markets and the economy.
Great, thank you, Jennifer. Good afternoon, everyone. Coming off of Q3, where nearly all assets were up, came out of a period across the summer when stimulus programs were very much underway and helping bridge us through the pandemic that we're in. Virus eased off a bit, and reopenings and reopening optimism carried the markets higher. We saw a bit of a resumption of economic activity. Now, unfortunately, as evidenced even further so today, a lot of that is unfortunately reversing a bit. Global COVID and the US election are both creating a lot of nervousness. Polls vary seemingly by the minute, and the COVID situation in the US is not great, and perhaps though is even Europe and other places are perhaps even worse in what's going on. So that's created some challenges. We're not here today to predict the election, but to try to talk about how we've positioned portfolios for the range of outcomes that could result. I think though, regardless of the winner of the election, and here when we're talking about the election, we're talking about not only president, but of course the control of Congress and the ability to pass legislation cohesively that is very much in play. But regardless of the winner, I think we would still expect to see market-friendly support in the form of some fiscal support, stimulus, other relief packages. They may vary in size and scope depending on who wins, but I think some form will need to be re-injected and renewed into the economy after the election. I think also, as often is the case with elections, the rhetoric of the campaign trail I don't think will immediately translate into policy. There'll be a bit of a reluctance and hesitance to rock the boat while the economy is still quite fragile. Now that may change over the medium and longer term, where policy implications could very much impact portfolios. But I think out of the gate, other than of course a degree of knee-jerk reaction kind of the morning of the election sort of thing, policy will otherwise be, I think, fairly steady out of the gate. What we're seeing in the markets is a lot of dispersion, and the headline markets are just that. They grab the headlines, but there's a lot of dispersion within the membership of the major benchmarks, indices, S&P 500, et cetera. And this is an appropriate time for active management and tilting toward those winners and away from those losers within the constituencies. So we have some tilts and themes in our portfolios right now that have served clients well. Among them, quality growth over value, particularly in stock portfolios. The technology sector over other sectors like energy and some of the other sectors that are battered by pandemic weakness. And then US stocks over international stocks is another theme that we currently have in play. So we do have some risk reward in portfolios. And of course, the actual portfolio varies a bit client to client as we customize them according to individual liquidity, risk profiles, tax situations, et cetera. But these are our general themes. We are modestly underweight stocks on an overall basis, on a market basis, given the uncertainty that we are talking about, and we'll talk more about today. We're neutral on bonds, conservatively positioned within that neutral dollar-based exposure, dollar amount of exposure. And we are overweight cash, so having some dry powder for instance of volatility that are expected to continue, that will create further opportunity for our analyst team to hopefully pick off some good opportunities and ideas and rotate portfolios. So election volatility is upon us, right in the middle of COVID and some of the Northern Hemisphere challenges that were expected, but are kind of glaringly painful as they kick off. So, and if the results of the election are drawn out, that could pose further market risk. However, though, markets are incredibly resilient, and clarity, even clarity of really any kind, even if it's bad news, markets can quickly adapt and position and carry on through even rough times. And so I think it's the uncertainty more so than the outcome, and the clarity tends to help set up markets to grind higher again once things sort of reorganize. So continue to tactically adjust at the margin, but otherwise portfolios should hopefully be set up for the long term and can ride this out in stride. The key challenges as we come for the rest of this year and into 2021 is really going to be about rotation. Sort of the inverse of all those successful themes that I talked about at the start of my comments, at some point will have to be unwound. The glory day of technology and all these work from home players and e-commerce players that have done very well will someday likely be rotated and replaced by some of the recovery themes and the value stocks that have been on the sidelines through the pandemic. The US likely won't outperform international forever, so that's another rotation that could be in play. And then bonds, of course, also are not to be forgotten. If we get the recovery and the inflation that the US Federal Reserve is in fact encouraging, that could mean a difficult time for bonds. So all those sort of rotations are in play. And we're debating that internally on a daily basis. We're happy to have our new colleagues from Wellesley Investment Partners around the table at these debates, and they have a global asset allocation framework and business cycle framework that's been very helpful as we have the debates, and we'll certainly be having many more of those. So we've been doing a lot of research and getting trades queued up and ideas queued up and approved and ready to go when we're ready to do more of these rotations more dramatically. We've done some nibbling, but nothing major yet. Still quite a broad set of range of outcomes that we have to stay diversified and positioned for. Hopefully we're closer to the end of the pandemic than the beginning. Hopefully that vaccine is coming, but unfortunately there are still some credible downside risks. Things like double dip recession, political gridlock, other challenges cannot be written off. And so therefore we have to be careful and cautious as we go forward. But Jennifer, hopefully that gives a roundup of the themes that we're working on a real-time basis for everybody. And I'm sure we'll delve deeper into some of those as the call goes forward. I'll leave it at that for the moment. Thank you.
Thanks, Dave. That's great. And just a reminder, please do feel free to submit questions in the Q&A that should be at the bottom of your screen. And I do see somebody just must have been reading my mind. You know who you are. Thank you very much. I know you well too. So Ryan, obviously the S&P 500 has had a pretty good run since the lows in March. And, we've seen a little bit of a dip recently, but do you feel that the performance is really justified given the state of the economy and what's going on with COVID-19?
Thanks, Jennifer. Hello, everyone. It's a great question. It's one we get from clients pretty regularly over the last 3 to 6 months. Short answer would probably be yes, but I would put a few asterisks along with that answer. Not to rehash the past, but just so everybody has a sort of a baseline to work with. You know, if you go back to the beginning of the year, we had a strong 6 weeks through February, up about 5%. And then over the next month, we lost about a third of the value of the S&P, only to rebound and recover all the losses, setting new highs in September. From the bottom on March 23rd, the market's up about 53%, and this is through yesterday, not today, and was up 6.5% year to date. So despite some pressure here in the last couple of days, we certainly have had quite a rebound. In terms of performance and what's going on, it's really important to recognize a few things about the last 10 months. There has been a sizable difference between winners and losers, and gains across the market really haven't been uniform. For example, the S&P is up 6.5%, like I said, but the more tech-driven NASDAQ index is up over 28%. International markets measured by the ACWX, which is the All Country World ex-US index, is down 6%. Russell 3000 Growth Index up 25, whereas the Russell 3000 Value Index is down 11. And the Dow Jones Dividend Select Index is down 17%. So different indices, different constituents, and vastly different results. So, you know, understanding the composition of some of these markets and the performance is very important and helps to sort of justify good versus bad. So just breaking down the S&P a little bit, index up 6%. However, tech is up 29%. And on the flip side, you have sectors like energy, which is down 50. Airlines, the airline industry is down 45. Hotels, resorts, cruise lines, down 45. Financial sector is down more than 20. So while the broader index is higher, some of the hardest hit industries and sectors haven't recovered and remain well below the levels we saw back in January and February. So, you know, I would argue the market is actually reflecting, you know, the performance of the underlying companies and the underlying industries. And sort of at the end of the day, we need to remember that, you know, when we talk about the S&P 500, the top 5 stocks in the index, Apple, Amazon, Microsoft, Facebook, and Google, represent 25% of the entire index. So the market performance does tend to be driven by the bigger companies in the index. Many of those are sort of winners in the current environment we're living in. A couple of other points just in terms of what equity investors, you know, we're dealing with today. David touched on a few of them in his introduction, but we have very powerful and conflicting cross currents. On the positive side, we have ultra low interest rates. We have accommodative monetary and fiscal policy, massive global stimulus, and to this point, a strong US consumer, which is quite surprising given, you know, unemployment rates where they are. So just talking about historically low interest rates are supporting higher asset prices and elevated stock valuations, at least for the time being. If you think about the period, the last period where the Federal Reserve anchored Fed fund rates near zero for a sustained period of time, that was from 2009 to 2015. And that low rate environment served to inflate equity prices over that 6-year time period. So low rates matter. They matter not only for stock valuations, but when we think about stocks relative to bonds, yes, bonds certainly play a particular role in portfolios, but even for income-seeking investors who have traditionally leaned on bonds for income, you know, the dividend yield on the S&P 500 right now is 1.75%, which is more than 2 times greater than the yield on a 10-year US Treasury. So people who are seeking income actually are even gravitating towards the stock market to get some of that income. As I mentioned, monetary fiscal stimulus has been a huge driver of performance through the summer. And, you know, we're getting to the point here where some of the benefit is starting to wear off. So some of the benefit from the stimulus is likely to turn into a headwind if we do not get further stimulus from government. A couple of comments on the consumer. We are a consumption-based economy, and somewhat surprisingly, consumers have remained highly engaged, supported by the stimulus checks back in the spring, enhanced unemployment insurance payments, PPP program. And, a lot of consumers have refinanced mortgages at lower rates and have freed up additional cash. The US Census Bureau came out with some data at the end of September in terms of core retail sales. In September 2020, we're up 4.2% compared to last year. So pretty strong numbers. What we've seen, though, is that there is a shift in how consumers are spending money. They're spending more on goods and things and away from services and activities. And I imagine many people on this call can relate to these types of things. People are doing fewer fun things, foregoing vacations and trips, making fewer restaurant visits, no ball games or concerts, things like that. And instead, people have opted to spend more money on goods to accommodate sort of the vast majority of time we're spending at home. Our homes have quickly become our place of work, place of fun, our place for relaxing, and our place to exercise. So people have been spending a lot of money updating their homes. They've also been moving out of urban locations into suburban destinations. So despite the COVID environment, single-family home sales have surged. And subsequently, people are sort of afraid to take public transportation, and we've seen a surge in auto purchases. A couple of negatives, though, and not all is good, obviously. We're in a very challenging environment. And after the strong economic recovery that started in April, the macroeconomic data has plateaued, and many of the benefits from earlier stimulus are starting to wear off. So we need to be very aware of that. The unemployment rate hovering close to 8%, just under 8%, is much better than it was when it hit 14 plus in May. And I'll remind everybody, expectations were that the unemployment rate might reach over 20%. So we've done better than expectations. However, job growth has stagnated, and lower income earners are being affected the most. So across many service industries like restaurants and hotels and other leisure industries, these are the most impacted industries as a result of the COVID pandemic. Recent study from payroll processors shows that the unemployment rate for people earning over $60,000 a year is now only 1% below the January 2020 levels, whereas those making under $27,000 a year remain 20% below January levels. So we do see a huge gap between sort of higher income earners and lower income earners. And that is problematic. And now, obviously, we seem to be on the cusp of another wave of COVID-related cases, both domestically and international, which will jeopardize the progress of the economy has made towards reopening. So just a couple of final comments on COVID, and then I'll conclude. But this does remain a very fluid situation and very uncertain on many levels. The market and the economy has been dealing with direct and indirect impacts from COVID for almost 9 months. It has had a significant impact on everybody's everyday life, our routines and the things we do, and many of us have lost loved ones during these times. Likely to be a lingering and lasting impact on many parts of the economy for the foreseeable future. And despite progress being made with therapeutics and on a potential vaccine, it's unlikely that life will return to normal for many of us for quite some time. We remain focused on identifying what we can in terms of trends, cases, fatalities, the economy, changes to consumer behavior, things that we can see. We're cognizant of all the damage that's being done to small businesses around the country. And as a father of 3 school-age girls, the strain on working families is also very real. And as long as children remain learning remotely, it'll be difficult for parents to even considering returning to the workforce. So there's a lot of things to be concerned about on the negative side. On the flip side, many large, well-capitalized companies have gotten stronger. We've seen the firsthand importance of technology in our everyday lives, but it's broader than just one economic sector. It's pretty pervasive across the wider economy. It's enabled companies to work remotely, like we are, to connect with family and friends, including this call with you all today. To have things delivered, groceries, essential needs, in a matter of days. And in the near term, as virus trends climb, our take is that isolated and maybe more limited lockdowns, smart lockdowns, are more likely than a complete repeat of the March-April time period where we saw widespread mandatory shutdowns. There appears pretty low appetite for a fully mandated lockdown, although just today it seems like France and Germany have taken steps to shut down bars and restaurants, at least for the next month. So we still have a lot of cross currents. There's still a lot of unknowables in terms of the COVID and where we go from here. So in conclusion, I would say despite the near-term uncertainty around the election, the surge in COVID cases, the economic data, that seems a little bit mixed. Our equity positioning hasn't changed all that dramatically. We remain modestly underweight stocks, as David alluded to earlier, and holding a bit more cash. We're overweight companies that are least impacted by the COVID pandemic and underweight the harder hit service industries. If the surge in COVID cases materializes this fall, as many expect, it's likely technology and growth-oriented companies that led the market higher this summer will likely continue to lead the market higher through the fall and the winter. So you may continue to see the Amazons of the world continue to do very, very well. If and when a vaccine is approved, we may start to see some rotation into the laggards, but we are not there yet. So Jennifer, I will turn it back to you.
Thanks. And Ryan, we're not there yet. Sounds like maybe something you might be hearing from your kids in the car. Are we there yet? So thanks for those comments. And I'm going to turn now to Eric to talk about fixed income. And, we like to think that fixed income is the anchor to windward and the returns are kind of slow and steady. But the reality is that fixed income returns have been pretty strong this year. So love to hear your thoughts on that market.
Yes, thanks, Jennifer. And that's a great question. Considering, the low interest rate environment that we're currently in, bond returns have been really strong this year in the mid to high single digits, so much higher than what forecasters had expected for 2020. And part of that reason is the amount of fiscal stimulus that has been acted, and as well as monetary policy. The FOMC has not pledged, but at their September meeting indicated that this low interest rate environment is probably going to continue for the next 2 to 3 years. So Fed funds rate will be anchored towards zero. And you look at the tremendous rally we've had in interest rates this year across the US Treasury curve. Most spots along the curve have come in about 100 basis points. And the expectations are that, with this record amount of fiscal stimulus, we could see higher inflation. We have not seen that yet, and it's really not being priced into the market just yet. Break-even spreads have bounced off of their lows, but they've sort of moderated over the summer months in a very tight trading range. So overall, very strong bond returns in the market this year, fueled by Fed activity, very similar to what both Ryan and David mentioned. So very accommodative Fed policies. Globally, there's been over 600 stimulus measures that have been announced, and we also have to put in perspective, there's over $15 trillion that trade with negative yields across the globe. And we're still very fortunate in the US, we have positive interest rates. So overall, expectations are we could see rates move higher at some point down the road, but at least for the near term here, we expect rates to stay range bound. And we're still finding opportunities in the bond market, even these low levels of interest rates. And very similar, to what David and Ryan mentioned, fixed income is a very important part in clients' portfolios. Again, you're buying the bond for principal protection as well as a steady stream of income. And both of those are valid reasons to own bonds. We don't see those reasons changing going forward. I think bond investors have been spoiled over the last 30 years, what has been termed this bull market in bonds, where back 20 odd years ago, the 10-year Treasury was yielding 6.5%, and today's anemic less than 80 basis point yield. So we've had again that tremendous rally in bonds, but we're still finding good opportunities in highly rated investment grade credit bonds in this environment. Spreads have compressed, but they're still wider than where they began the year. So the investment grade index has tightened about 260 basis points. High yield spreads have tightened about 500 basis points, and they're still much wider, wider than where they began the year. So we're still finding opportunities in select investment grade credits. There's been a lot of talk of leverage being increasing in the corporate bond market. We're looking at net leverage, where a lot of sectors of the corporate bond market, net leverage has actually decreased as corporations have ample cash on their balance sheets. So we are comforted that our research is showing that we're able to find high quality companies in this environment where we expect these credits to remain strong credits as we move forward. I'd be remiss if I don't talk about the Muni market. Obviously, the Muni market is ground central right now for the pandemic relief. There's a lot of states are experiencing surges, and expenses are expected to increase going forward. But the investment bond market has also rallied, like we've seen in the corporate bond market. Spreads have tightened across most states. And I think there's a reason for that. Number one, the CARES Act. So each state received no less than $1 billion in the first round of stimulus. And as Ryan alluded to, with the lower wage workers losing their jobs, so income tax receipts has actually stayed steady, as most of the higher tax earners kept their jobs during the pandemic. So state income tax receipts haven't really declined as much as what was feared. And at the start of 2020, there was 33 states that had rainy day funds exceeding their pre-Great Recession level. So states' finances were actually in solid shape coming into this pandemic-led slowdown. So these rainy day funds represented the largest element of overall state balances, accounted for about 63 cents of every dollar in aggregate balances, which was higher than 45 cents during the Great Recession. So state balance, states are in pretty good shape. And bear in mind, as part of their constitutions, all states have to file a balanced budget each year. So during the course of the year, if that balance if their budget becomes unbalanced, there's some levers that states can use to rebalance their budget. They can cut expenses, via furloughs or layoffs. And as we've talked about more aid, the second round of stimulus is expected to give more aid to states, probably happening post-election year. But not as all rosy. 7 states have made withdrawals of their rainy day funds so far in 2020. And states have also, is moving forward into 2021, are expected to start hitting their rainy day funds to help balance their budget. But I think one thing to keep in mind, overall, we invest in high quality bonds in both our municipal and our taxable bond portfolios. In our municipal bond portfolios, we expect the high quality bonds to remain high quality, even in this type of environment. If we go back, Moody's has done studies over long periods of time in high quality bonds. And again, over these long periods of times, there has been a lot of stresses in state finances due to, remember, the dot-com bubble in 2000, 2001, we had 9/11, we had the Great Recession of 2008 to 2015, and all these states came through with passing grades. So overall, there's a very low default rate for high quality municipal bonds in the market. And we're purchasing individual bonds where our research has indicated that these bonds are credit worthy, and we can hold these bonds till maturity to mitigate any sort of losses that may happen if interest rates rise down the road. And with that, I'll turn it back to you, Jennifer.
All right, thank you, Eric. And Eric mentioned the CARES Act, and so that was a good segue into what David Strawn is going to talk about, which are the tax and legal changes that we should be aware of, both prior to the election and then potentially after the election.
Thank you, Jennifer. There's a number of different potential and existing tax and legal changes that our clients should be aware of. First of all, there's the Secure Act. The Secure Act was made into law in December of 2019. And really what the Secure Act, the main portion of the Secure Act raised the required beginning date for individuals taking withdrawals from retirement accounts from the age 70 and a half to age 72. Now, this potentially allows clients to have additional savings and additional referral of taxes. And also beneficiaries of retirement accounts, though, after the death of the survivor of the donor and the spouse, the beneficiaries must make a full withdrawal of a retirement account by the end of the 10th year after the death of that survivor. Now, that's a potential negative because that creates a lot of taxable income, maybe unexpected by the by those recipients. So important planning is needs to be accomplished when providing a retirement account as an inheritance to children or others. There's the potential to designate a charity as a beneficiary of a retirement plan in this case. Also, with individuals being able to defer the start of their retirement distributions, it's important to consider when you should start taking those distributions. Should you start taking them at an earlier age, or do you want to wait until age 72? Another thing to consider is we have the election coming up. We've all spoken about that. Should a Biden presidency come in and the Democrats take both houses of Congress, there is a projection that there will be some significant tax law changes. Now, while the Biden campaign has not formally submitted a tax proposal, Mr. Biden has endorsed a number of tax plans from the Obama administration and one submitted by the Bernie Sanders campaign. These include many different changes to what we have now, including a reduction in the federal and generation skipping tax exemptions from the current level of 11.58 million per person to 3.5 million per person. In addition, there would be a reduction of the lifetime gift tax exemption from the current 11.58 million to 1 million per person. There would be an increase in the estate tax rates from the current 40% over the exemption amount to 45, a sliding scale of 45 to 77% estate tax rates. That 77% rate would be on estates over $1 billion. There would be the potential for the elimination of the step up in basis on the death of an asset owner. That's a significant consideration, as we have many clients with greatly appreciated portfolios, and the step up in basis is a nice opportunity to reset the tax basis. And those assets, quite often, the step up in basis allows people to avoid the capital gains tax while still having their assets exempt from estate taxation. There's the potential for an increase in capital gains rates from the current 15 and 20% to ordinary income tax rates, which would be up to 39.6%. Finally, the timing of the enaction of these potential changes could be anytime during as early as January 1st of 2021, if they're made retroactive to the beginning of the tax year, all the way to the beginning of 2022. So it's very difficult to plan for any of these because we just don't know when they're going to be enacted and what is going to be enacted. The final item, just to be aware, is even if there is no change in the presidency and there's no change in the House, either the houses of Congress, there are some guaranteed tax changes that are already scheduled to happen because the tax package that President Trump shepherded through Congress about 3 years ago has sunset provisions in there, including the federal and gift and generation skipping tax exemptions, which again are currently 11.58 million per person. They are set to sunset to $5 million per person on January 1, 2026. In addition, the income tax rates are also scheduled to revert back to the old brackets, topping out at 39.6, also on January 1, 2026. It's really important for our clients to consult with their advisors to plan for how these changes will affect them. So Jennifer, I will say there's a lot for our clients to consider and think about and be prepared for. So these elections do have consequences, and certainly over the next few months, we'll see where things settle out. And certainly our relationship managers and our financial planner are available to assist our clients as they need. So thank you very much for your time.
Thank you, David. Appreciate everybody's comments. And we have a few questions in the chat. So why don't I start with the first question that came in, which is, when we talk about overweighting cash in our portfolios, what does that mean in terms of a percentage that we would hold in cash?
That will really depend on the individual client situation. But for most folks we advise and institutions, we advise 2.5% is sort of the baseline of cash. And so in this time, we would be at between 5 and 7.5%. So roughly double what you might usually have. Now that varies by everyone's comfort level. I'll also vary by the degree of risk that you have either in your personal life or in your investment portfolio. Perhaps you have illiquid assets, large real estate investments, or other things that might change that number up or down slightly. But generally that 2.5 would be something on the order of 5 to 7.5% currently.
Great, thank you, Dave. Eric, you talked a lot about what's going on in the bond market. You talked a little bit about municipals. Are there other parts of the bond market that you're finding attractive, perhaps in the taxable bond market, or are we looking outside the US at all?
We do have a small allocation via an active manager to dollar-denominated emerging market debt, and we would expect to continue that allocation moving forward. As I mentioned earlier, we like all type of spread product in here. So we're underweight U.S. Treasuries, especially at these anemically low yields. We prefer to increase our allocation to investment-grade credit. As well as we've been adding some mortgage-backed, as even though the federal government or the Treasury is buying, about 80% of the new issuance of that market, those spreads are still about 1 standard deviation above their mean. So we're finding those relatively attractive as well. So I'd say between investment-grade credit and mortgage-backed debt, we do have an allocation to bank loans. That index has, substantially rallied as well. Not back to normalized levels, but definitely well off of the lows that we saw back in March. So we do have an exposure again through an active management and bank loans, as well as very conservative high yield products. So we still like any type of what we call sectors that have spread associated with them.
Great, thank you, Eric. The question that's been on my mind since Ryan talked about growth equities doing so well, I can remember hearing presentations going back at least 10 years from value managers saying, it's compelling, it's incredibly compelling. Value has to come back sometime, and it hasn't. So do you have, I know you won't give us a full prediction, but what are your thoughts on that? And do we think that value will ever come back?
Yeah, sure it will at some point. I think as part of every risk management within a portfolio and within, an equity strategy sleeve, I think we are always trying to take profits, reduce positions, control position sizes, be cognizant of our position weighting versus the index weighting. So just because we have 5% in Apple, many people might think that's a lot, when in reality, Apple is 6.5% of the index. So at 5%, you're actually underweight relative to the index in Apple. So it's a great question. I think that in this day and age, with low interest rates, with really challenged growth, growth. As I said earlier, technology is broader than just the technology sector. And I think that's really important, because you can look at healthcare and think of Medtronic and think of other healthcare related companies that incorporate a tremendous amount of technology in what's happening with medical devices and other things. The utility companies, the industrial companies, all incorporating artificial intelligence and different parts of that. So I just want to be clear that technology to me is more than just tech sector, but maybe just to circle back, Jennifer, there will be a time and a place when industrials become, when cyclicals or value becomes more sort of, in favor. We've had a couple of head fakes earlier this year that haven't materialized. And when you think about value sectors in general, that would include banks, which are extremely challenged in this current low rate environment. That would include energy, which is completely out of favor with investors. We're seeing a huge push towards renewable energy. So your traditional value sectors are really, really under pressure right now. There will be a day and a place when value comes back in favor. I think maybe it's not today. So
that sounds like as close to a prediction as we're going to get from you. So we have a question about diversification in our portfolios, and I think the subtext of the question is, in all of these challenging markets, when we get volatility, all of the asset classes seem to move together. So how do we think about adding diversification to the portfolios to weather that volatility?
I can take that. I'm sorry that my video is temporarily shut down, but this is Dave Lynch. We're looking at a lot of places to add further diversification. Obviously, we always are in play with global diversification. Eric mentioned emerging market debt. We have equities around the world as well. In fact, many of the U.S. Positions are globally diversified in their own right in their revenue streams. We have added gold for many clients as a diversifier. We continue to do research on additional non-traditional forms and formats to even further diversify beyond stocks and bonds into other asset classes, liquid alternative, et cetera. But there are quite a lot of levers we can pull within the current assets that we have within portfolios and within allowed benchmarks and things. So I don't think we need to be very dramatic with what we're doing. We're already quite global, quite diversified. And when you look at the subsectors of equities and how thinly at times we slice that in our research, as well as how thinly we can slice fixed income into different pockets of opportunity, there's a lot of levers available to us on that.
Great, thank you, Dave. We have a question about Reits and what is our thinking on Reits and do we hold them in our portfolios?
I'll take that, Jennifer. We do own REITs. We're very selective at this point in terms of the industries and the end markets that those REITs do serve. We have been more heavily invested in 5G build out, so tower REITs, industrial warehouse factory warehouse REITs, which serve e-commerce companies like Amazon and UPS and other large companies that are benefiting from the large e-commerce build out. So and data centers, there's another area within technology. It's a different way of playing technology, but REITs that house data centers that provide the tech support of Amazon Web Services and things like that. So it's an interesting, we did a review of utilities just a few weeks ago within our group. And just as an example, there's parts within every industry that are good and bad. And I think REITs is a good example of that, where you've got some REITs that are doing extraordinarily well, that are very well positioned. And then you have other REITs which are tied to malls or commercial real estate or other areas which are just sort of secularly challenged right now. So we've made our bets on the former, not the latter.
I think the message that I hear from all of us is that, okay, I'm also having problems with my video, so I will keep going. But I think the message we're hearing is that we really do slice the markets thinly, and we do deep research on those markets, and we bring those very specific ideas to clients' portfolios depending on their particular objectives. So David Strawn, why don't I ask you about the changes in legislation with inherited IRAs? And it seems to me that that may in fact have clients thinking about increased use of IRAs as gifts to charity. So maybe could you address that for a moment?
Thank you, Jennifer, for the opportunity here. I would say that right now there's a great opportunity to use your IRA for gifting. An individual is allowed to give up to $100,000 of their IRA value in annually as charitable gifting to make charitable gifts. It can be one gift, it can be many gifts. And so one of the real benefits is that when you make a gift in that regard, you do not realize the income on your income tax return. You also do not show the charitable deduction. So what happens? It's an offset, and your adjusted gross income does not get increased. So it's a really great opportunity to make charitable gifts. I will also say, Jennifer, that with some of this, with the Secure Act that came into place this past December, using a charity now means it can make a real big difference upon the inheritance of the charity, because depending on where you reside, and Massachusetts has right now a $1 million estate tax exemption, it could really help offset any estate tax that might be realized upon the death of the surviving spouse. So I think there's some very nice opportunities for using an IRA for charitable giving.
All right, thanks, David. Another question, what are the indicators that you'd be looking at to move away from tech equities?
Another one for me, I guess.
You're always the popular guy, Ryan.
Everybody likes to talk about stocks. Great question. I mean, the reality is it represents 25% of the market. And, I can't envision a scenario where we were, too far under, maybe 20 to 25% being underweight at some point. And it's an interesting question because, a lot of people like to draw comparisons to 2000 in the tech bubble. And, the reality is that today is a lot different than 2000. Today, the top 25% of the index, those 5 companies I referenced, generate 20 to 22% of operating profits in cash flow of the index. Back in 2000, they generated 2 or 3. So the dynamics and the business models of these companies, and let's be honest, most of them have virtually no debt. They're free cash flow positive. They have huge wind flow balance sheets. They're investment grade companies. So I don't mean to duck the answer per se, but the reality is these are very good companies, maybe slightly overvalued. Maybe some of the software companies are overbought in the near term. But I would say penetration of work from home and these types of things are still sort of in their infancy. We're still talking about huge addressable markets for online sales and e-commerce sales. There's a lot of companies that don't do that still. You have Amazon, but so great question.
Go ahead.
I would like to just say that we'll take profits as time goes by and reduce those positions as need be.
Yeah, that's a great segue, Ryan. I was just going to add that it's as much about the valuation of the technology stocks themselves, but it's also just how cheap, relatively speaking, the alternatives get. How beaten up do the pandemic-ridden sectors get that they become a compelling valuation in their own right? Careful that they're not value traps, of course. And then how do you pay for those? Well, us and a lot of the market has accumulated and warehoused, I guess, a lot of portfolios in the tech sector. And up to this point, it's, well, the financials or the energies or certain healthcares or the travel stocks, they're beaten up, but I'll still hold my Apple, thank you very much, or I'll hold my Amazon, thank you very much. But at some point, it may say that, well, on a relative basis, maybe we can use the proceeds from that technology to fund something else. So it may be as much about something else getting attractive as it is about technology becoming unattractive. I think because of all the secular wins that Ryan talked about, they're going to have a very solid perpetual place in portfolios, really, in perpetuity, given how embedded they are in our lives now.
Thank you. So I saved the most optimistic question for last, which is, as we think about the notion of a vaccine sometime, and life starts to return closer to normal, what do we envision for the markets and our portfolios? And why don't maybe you can start with Dave Lynch, and then Ryan and Eric can just jump in very quickly, and then David, if there are things that you are seeing from the planning perspective, feel free to jump in as well. We're getting very close to 5, so keep it short, and I promise not to mute you, but don't go on too long.
Okay, I'll try to come at it a little bit from a top-down basis. As much as I think we all look forward to the return to normal life, we have, in certain respects, borrowed from the future. I alluded to this a little bit in our recent letter, that and there's good borrowing in that we've pulled forward a lot of the clients and customers that Amazon or Zoom or other e-commerce or work from home folks had planned to find in 2021 and 2022 and 23 are already here. And so that's sort of good pulling forward. But then we've also taken out a lot of debt at the government levels, and through the stimulus programs that will have to be, well, it's a matter of debate just how much debt is too much debt, but it's a lot. And some will have to be paid back or at least moderated as stimulus programs ended eventually on these happier days. And that lowers the trajectory for forward returns to a degree. So there's a bit of a moderating in our forward expectations, and these are things we're considering in the financial planning longer term context in terms of what asset return potentials are. And then we'll just the rotations that we mentioned before, and returning to the sectors that we've moved away from. But I'll let Ryan and Eric, I don't want to step on their toes on those, so go ahead.
Right. So I would highlight some of the industries that I referenced earlier that are still down 40, 50, 60%. I think inherently, as a population, people like to travel. They like to go on vacation. They like to take trips. And at some point, it may be more than a year away, but at some point, I think people would like to get back into that, taking trips, going on holiday, whatever the case may be. But there's a couple of less obvious examples. We've talked internally about some of our healthcare companies, and people have delayed visits. So volumes are way down in hospitals. So at some point, that getting back into the normal flow of your doctor visits, your routines, screenings that you delayed and put off, surgeries that you should have had maybe and didn't. So there'll be opportunities in healthcare when people start to get back into their normal routine. There'll be opportunities in travel and leisure and in retail. The last area I would mention is probably something that's, irrespective of sort of a reopening, but there's probably a huge opportunity for the next 20 years in renewables. That's an area where, regardless of a Democratic or Republican president, the utilities and the power companies are really leaning into renewables, and wind and solar and battery storage are all becoming a much bigger part of our power generation industry. So we're less likely to fall back on coal. That's going away. Nuclear is probably going away. It's going to be flat for a long time, but that's an area that's probably going to has a lot of legs in front of us.
And Jennifer, if I might, before Eric goes, just a nod to the teamwork I want to give is that the analyst team, even in these beaten up sectors, is hard at work. And so some of the names that we sold earlier in the year are still under coverage. We don't forget about those names that were sold in the travel and leisure or airlines or otherwise. But so those analysts are there and maintaining those models, and will be ready to go in the time and place when it's time to make those moves. Go ahead, Eric.
Thanks, Dave. Okay, so Eric, quickly, and David, if you have something, we'll keep it very short.
Sure. I just want to talk more what David Lynch said about, the amount of stimulus that has been acted and possibly a second round is inflating the amount of debt the U.S. Treasury has outstanding, and that at some point has an inflationary impact, and which could cause rates to move higher. So we looked at as, where most of our portfolios are duration neutral. And we looked at, if rates move higher, we looked at it as an opportunity to start locking in some longer term rates here. If we see spreads on investment grades move higher, we would look at that as an opportunity to leg in some additional purchases into high quality companies. And, if the economy comes back on track because of the vaccine and the work and back to work happens in a greater extent, I would expect municipal bond, finances to improve as well. So there's definitely some sectors that will benefit. And I think mostly municipal bonds as, tax receipts edge higher and there'll be less expenditures for the pandemic. So I think we're overall, and states have learned in the past, and in the good days, they increase their rainy day funds. So in the bad days, they have ample reserves. And I would expect going forward that state finances will continue to improve as we move forward with the pandemic.
Great, thank you, Eric. And anything to add, David?
Just a small comment that, with the increase in the required beginning date, it's a great opportunity for people to save more for their retirement. We're an aging society, so it's a great opportunity to put more money away and have more money for when we need it more at an older age.
Excellent parting advice. Thank you, David. So I'd like to thank all of you as panelists. Great job. A couple little tech glitches there, but we did very well. And I want to thank our clients and friends for participating today. We will be, as I mentioned, posting this to our website, and we will also send out a link to those who participated. And so thank you again. We appreciate that you took the time to spend with us, and we'll look forward to speaking with you soon. Thank you, everybody.